Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, September the 8th. My name's Eric Wilkinson. Some of you might recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that I talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Not a whole lot of economic data today. We did get unemployment claims came in at 259,000. Expected to be 264,000. So unemployment claims lowering is better in the sense that less people are out there actively seeking unemployment, but that doesn't account for the discouraged workers, which is a whole different ball of wax. And we have record numbers of discouraged workers out there in the United States. We also had natural gas storage come in as a drawdown of 36 billion cubic feet versus the expected 44 billion cubic feet, and crude oil inventories, a massive drawdown of 14.5 million barrels. It is the second largest drawdown on record, and it is the largest drawdown since 1999. It was expected to be a build of just over a half a million barrels of crude. Now, let me dig into this number. So when you see the headline numbers, everybody is freaking out. Oh my God, there's a huge drawdown. As you can see here, crude oil up almost $2 on the day, looking at, well into the 47 handle, just blasting higher. Yesterday, we saw some of the earlier data points on the EIA numbers, and they were giving a bit of a sense of a big build. And today we've got the real number, and that was last night was a drawdown which caused it to rally, and then we got the real number today showing that big drawdown. But once you dig into these numbers, people, this is what you got to do, is do your own homework. The real number tells you a lot about what is going on, but it doesn't give you the minute details as to what's really going on. They have something that's called the PADD, the pad numbers, and those are where the oil's imported. And one of the biggest importing locations is in the Gulf of Mexico. That's PAD3. They had almost 9 million barrels undelivered because of the storms in the Gulf. So those are waiting to be delivered. So they're en route in a sense. So that is going to come into play here shortly. And then if you put all of these undeliverables with the East Coast and everything else, that puts us at almost 13 million barrels that were undelivered to the United States through those different ports. That almost puts this number at a wash, all right? So keep that in mind going forward. We could see all that coming in. We also saw capacity utilization for these refineries go from, it was expected to be a pullback of about 0.4%, was an increase of almost 9%. So that whole thing, that refinery utilization is going to come in to play here shortly. So those people are going to be starting to really ramp up on that. We did see gasoline inventories draw down, again, going to be correlated to this whole disruption in the system. And distillates was another build. So that goes back to the manufacturing side, that the manufacturing isn't taking those inputs into the production process. So all of those things are not really great signs. We got crude oil cruising higher, but that's from the headline number. Dig into that. It looks like it's a good time to start fading crude oil again. I have on a put calendar in there where I am short the front month, long the back months in the puts. So I'm going to be looking to cover those short puts soon, because they're basically worth a nickel after today's move, and then just leave on my long puts to ride. But I haven't gotten out of those yet. I'm trying to get it below, wait for it to get below a nickel, so I don't have to pay any commissions. Then on to gold. Gold being down, the rest of the market seemed to be not too happy whatsoever. The equities are kind of looking at that number on the crude oil and fading it, as I am as well. But as you can see here, gold futures down almost $8 on the day, trading around $13.41. Then we got bonds down big, also down almost 2 points on the day. Really just completely retracing. A lot of people, thinking that when you see these big drawdowns in crude oil, it starts making people think that the economy is actually starting to look better. People are buying gas and people are consuming. But this number is out of whack because of the from the delivery disruption. Then we have on to NASDAQ. NASDAQ down pretty decent today, down 26 points on the day after yesterday's historical high, trading at right around 4,800. Then E-mini S&Ps /ES down not quite as much in percentage terms as the NASDAQ, down just over 4 points as we speak. Then if we look at the data points on or the breakdown, I should say, 15-minute chart of the E-mini S&Ps. This right here shows overnight we really started sliding off. And then we got the data points. Market really spiked higher, but now the euphoria started to lift again in the equities, and they're starting to slide. Then on to what I've done. So I've got this target on still. I actually was short some puts. I got the puts put to me, so now I'm actually long stock in Target, and I've been selling calls against that. I've been selling the 72.5 calls. I initially started with the SEP 72.5 calls. Now those have decayed almost to nothing, so I rolled that out in time to the October. I rolled the SEP to the OC 72.5 calls and collected another 57 cents. What I'm trying to do there is lower my cost basis on Target. I'm long at 72, and if I can continue to just roll this out in time, lower my overall cost basis on Target, I'll have it a lot cheaper and lower my break even on that long stock. That's what I'm trying to do there. Stay mechanical as I try and teach you guys day in and day out. Don't get emotional with these different stocks or options. Stay mechanical, play the probabilities. The probabilities will play out in your favor, and time will be your friend, as I'm looking for with Target. Target's not going to go out of business. I'm not overly concerned about Target. They actually beat earnings, and forward guidance wasn't great, but they still beat earnings and are going to do well in a recessionary type economy because they are the lower price point. They're doing groceries and everything else, and that's where people will start to shop. On to Apple. Now, Apple came out with a big announcement yesterday on the iPhone 7, and it today is pretty much a bust. They're actually getting rid of the headphone jacks for your iPhone, so you actually are going to have to start using these wireless headphones, which, they think is a great idea. They should actually give the consumer the choice. They are taking that away from the consumer, mostly probably in part due to the fact that they want to try and capture that market on the headphones. If they're these little tiny headphones that are separated and are going to get lost, it's going to generate more income for them on these, because if you lose one, you got to go back and get the other. So I think that was a bit of a bummer for them, because the overall market's kind of like, well, I kind of like my headphones. Maybe I want the big nice bow headsets where I can plug them in, and they're not giving the consumer that option at this point. So, that may backfire on them. Now, I am short Apple through an earnings trade, believe it or not. And with Apple, I have on the September 100 calls. So I rolled those SEP 100 calls that I'm short out to the October 100 calls and collected another 80 cents for that. Again, lowering my cost basis on Apple, trying to get my break even a little bit higher, So it seems a little weird, but I'm short the 100 calls. Now I'm synthetically short about the 101.5 calls. So if it gets to 101.5, that's right around where my break even is. So I'm increasing that break even level. I don't have to get all the way down to the 100 calls anymore to get, or to the 100 level to get to break even. If that makes sense. I hope I didn't butcher that too bad for you, but the more I collect, the higher that break even increases. The underlying, so I'm lowering my cost basis there. All right, so sorry about confusing you. I think I confused myself a little bit on that, but that's the way it is. When you're collecting more credit in your long stock, you're lowering your basis, which when it's against you is lowering your break even in a sense. And then with the calls, because I am short the 100 calls much lower, every time I collect a credit, it increases my break even that way. So, all right, I hope I explained that pretty well for you. If you have any questions, you can reach out to me at trading@ProTrader Strategies. And Friday's webinar, I'm actually going to be doing a couple of them. I just got a little note here. I'm going to be doing an event with Steve Bigelow from ProTrader Strategies. Got a lot of people signed up for that, and I'm going to be doing something on ProTrader hacks. So check that out. It's going to be a way to streamline your process on discerning what the Greeks are telling us. So check that out. You can go to ProTraderStrategies.com. Friday's webinar is going to be on synthetic long stock, and we're going to be able to purchase stock and have it simulate exactly what stock does for about a quarter of what it would cost you if you went out and just say bought Apple outright. All right, so that's all I got for you guys today, other than if you can't take that, take it easy.